there's a pro and a con to all of this. And I remember that when interest rates were heading down towards zero and then stayed near zero for a long time, there was a lot of discussion about, savers are getting the short end and they're getting screwed. They're not getting what they've become accustomed to, and this is terrible for people who are in their twilight years. They're not getting any income from their savings. And what was ignored in that conversation was the fact that rates heading down towards zero inflated the value of their fixed income portfolios. So the value of whatever they owned, whether it was any type of bond, obviously cash holdings didn't gain in value, but there was a wealth effect towards savers if they had invested in bonds. And now we're seeing sort of the inverse of that. So bonds have lost value over the last 4 years as rates have risen very quickly. But now you're getting paid to actually own those. So it's not a wealth effect, but it's sort of like an income effect. So people are now getting, yes, it's a government stimulus. So just to agree with what you said, I don't know that you asked if the Fed knew that it would be helping the economy by raising rates. I don't think that's the case, because the purpose of raising rates was not to help the economy. It was to actually slow the growth in the economy. And that has also happened. But it's also true that savers or consumers are now being rewarded. Those who have assets are being rewarded. And so I think that may be part of the reason why the consumer is okay. That's something that gets talked about a lot, is the consumer's okay. And over 70% of the economy is a direct correlation of the health of the U.S. consumer. And so if they're healthy, then generally you're not going to see a recession. So long story short, I think it has been helpful in one way. It has achieved the primary goal, which was to reduce inflation. And secondarily, I do think it's actually putting money in people's pockets, people who have assets to invest in either short or long-term fixed income securities. I do think it's a trend. I think it's been a trend for kind of a while, like 6 to 9 months. I think we can somewhat confidently say that rates have been in decline. I know there's been some hiccups, and the rates have perked back up a couple different times. Like, for instance, there was a not so great inflation reading a month and a half ago that caused rates to perk back up. But the thing is that when they're perking up and then they're hitting a sort of a ceiling at a lower point than the time before. And so we call that a series of lower highs, and that appears to be, rates have peaked back in 2023. We're now in 2024, and people are still talking about how we're in a higher for longer environment, a rising rate environment even, and I just don't think that's true. I think inflation has clearly peaked. At this point, it's almost 2 years ago that inflation peaked at about a 9% reading. That was just a bit of a one-off. But we're now below 3% on every reading, meaning trailing 1 month, trailing 6 months, and trailing 12 months. So I think we can say that inflation it's back down, not quite to the Fed's target, but it's clearly on its way to the Fed's target. And I think that's obviously a big contributor too. So you're seeing that the long end of the curve, the 10 and the 30-year Treasury, those are lower than they were in the recent past. So I think that's the way of large pools of money betting that that inflation expectations are coming down. It's hard to say. I'm not well versed in the market mechanics necessarily of why the VIX, for instance, the fear gauge, has just remained subdued. It may have something to do with the fact that there is an alternative to stocks, and so there's people have a place for fixed income and even cash in their portfolios, and maybe people have more balanced portfolios today than they did 2-3 years ago, which might translate to less need to have knee-jerk reactions when the value of their stock side of their portfolio drops. Maybe that's just sort of me riffing. I don't really know, other than earnings have been okay. Obviously, we see there's narrow leadership in the stock market, but the companies that are leading are just, producing incredible amounts of cash flow. And I think that there hasn't been a headline reason for investors to panic. That's not to say that there won't be one soon. We all know that there's an election coming up. These wars are just kind of ongoing. They're horrible for those who are directly involved or even indirectly involved. But the headline shock of them happening is sort of worn off a little bit. I think there's a little bit of a malaise about it. Maybe there's expectations that they're going to end at some point, but I don't know. I think a headline that would cause a market correction of that size would have to be, one of these market leaders having some sort of a disastrous earnings report, or news that something is getting much worse with one of these wars, or some shock politically, most likely here in the United States. And at the moment, we're not seeing that. There's a couple questions there. Is technology a crowded trade? How does the fact that we've got such narrow leadership affect our portfolio construction? And just to quote it back to you, 60% of this year's gains are from 5 securities. And we're seeing that in the headlines. I'm sure most of the people watching this, that's not going to come as a surprise. It's being presented as bad news. There's only a handful of stocks that are accounting for the market being up. If it weren't for them, the market would be flat or maybe even down. Okay, well, that's not the case. And I think whoever is presenting this information has an agenda generally. And if I'm trying to scare somebody, I'm going to present that as that's a really scary thing, and it just means that it can only last so long, and all the other stocks are struggling. When in reality, most market advances are led by something. They're led by maybe not necessarily a handful of securities, but they might be led by a sector or two. There's always securities that are leading to the upside, and there's also securities that are leading to the downside. I'm having a little bit of deja vu because I think we had this same conversation last year when, surprise, surprise, tech was leading. But in 2022, tech was leading to the downside, and people are quick to forget. But 2022 was a horrible year if you owned Netflix, Amazon, Google, Facebook. Facebook, I think, was down 70% in 2022. So yes, those securities are leading the way, and they're more volatile. So I don't know that it's necessarily a bad thing that leadership is narrow. In fact, one way to look at it is if breadth were very strong, if every stock, every sector was at an all-time high, that might feel like, hey, there's really kind of only one direction to go. But with narrow leadership, there's all these other securities that can now provide a little cushion if these 5 leaders they need to take a break at some point. They don't just grow at an accelerating rate. At some point, they will cool off and they will have corrections, and that will leave room for the rest of the stocks in the market to maybe do a little catch up. All right, so what could go right? There's a couple I think kind of key points that we can touch on. One is, and this, what could go right? Just in the last week, we've seen renewed headlines about this potential insolvency of some banks in the United States, specifically related to their held-to-maturity portfolio. The long-term treasuries that they're required to hold a certain amount of risk-free assets on their balance sheets. And as rates spiked up in April and May, again, there were unrealized losses that started to show up on their balance sheets. This is similar to what happened 2 years ago when we had the regional bank crisis, ultimately resulting in the failure of First Republic. And it's not, I don't think it's the same now. I don't think the rate spike was nearly as severe. And also almost as if on cue, as soon as we saw that headline, TLT rallied, which is one way of monitoring what's happening with the long end of the curve, and long-term interest rates came right back down, 20, 30 basis points, which is meaningful. So, and that provides a huge boost to the held to maturity portfolios that are being referenced. So I don't think it's the same. I also think that the Fed and the authorities are much better versed in the issue there. So if there were something starting to percolate, I think they would be very, very responsive. That's one. So one thing that could go right is I don't think that is something that's going to come to fruition. Also, the result of the long end coming back down, and you earlier referenced mortgage rates peaking below 7% for the first time in a while. There may be a little bit of a resurgence in activity in housing, and possibly even refis for the first time in a while. Not attractive to people with 3 or 4% rates, but people who just got into the market in the last 18 months, they may have the opportunity to refi already. So there may be some activity in banking in a good way. So that's good. Number 2, politics. I know that this is a hot topic. I don't really like talking about it, and people probably don't like hearing about it. But the bottom line is, we've got an election coming up, and we're going to have either Trump or Biden in the White House in next year. So it'll be Biden again, or it'll be Trump again. And the only thing I'll point to is that there are skeptics on both sides of the political spectrum, but market did well under both. The market ran up to all-time highs pretty early on in Trump's first presidency, and the market is at all-time highs now in Biden's presidency. So I think really it's just a good reminder to keep politics out of investment decisions, because we don't know what's going to happen. We don't know really which policies are going to be enacted, when they're going to actually be enacted, and what the impact will actually be. So those are 2 things that can go right, I think. Another thing that, just pointing to some data, when the market is up double digits, and the S&P was up double digits through the end of May, when that's the case, almost every time it finishes the year even higher than that. And in particular, when May itself is strong, and we had a good May. So just sort of statistics point to the rest of the year being good. Obviously, it's an election year, which throws another wrench in, but the data's on the side of the bulls right now.